this lecture we are going to talk about the IAS 12 income taxes. You may have some objective test questions from this standard, plus if you are having a final account question in the case study, there is going to be an adjustment related to the tax where you are required to calculate the tax liability for the statement of financial position and the tax charge for the statement of profit or loss. So in this standard IAS 12 we are going to talk about the current tax and the deferred tax. So first of all, we are going to talk about the current tax. Now this current tax is known as the current tax provision. Why we call this as the current tax provision? Because this tax is the estimated one. The companies are required to pay the tax in advance. So when they are going to pay the taxes in advance, they are going to estimate it first. So when we are talking about the estimated tax, that means when the actual tax is calculated, the actual tax may be significantly different from the one you have estimated. And that will lead to the under and the over provision, which we are going to discuss shortly. So current tax is the amount of the income taxes payable or recoverable in respect of the taxable profit or loss for a period. That means it is going to be for the particular year we are talking about. At the period end, an estimated amount is therefore accrued based on the year's profit. So when you are booking this tax, you are going to debit the profit or loss. That means we are recording the tax expense, and credit is the tax payable. This is the liability. When you will be paying this tax, you will be de-recognizing the tax liability, debit tax payable, and credit bank. As I've told you that this is the estimated tax. This is the estimated tax. This is the provision for the tax. When the actual tax is calculated, there will be the difference between the estimated and the actual tax, which will lead to the under and over provision. So what is the concept of the under and over provision? So when the actual tax is calculated, it is compared with the estimated tax. If you have booked less tax, then that will lead to the under provision. If you have booked more tax, then that will lead to the over provision. So an under provision is simply the case where you have booked the less tax. You should have booked more tax, but you have booked the less tax. Now what should be the treatment? You are going to increase the current year tax charge. The over provision is simply opposite. Over provision means that you have booked more tax. You should have booked the less tax. Now how to treat this over provision thing? You are going to reduce the current year tax charge. So an over provision arises where the actual tax paid is less than the estimated tax. This reduces the following year tax charge in the statement of profit or loss. Now, one thing is very important for the exam. Whenever you are having the objective test question or, for example, the final account question, most of the time the under and over provision is given in the question and in the trial balance, but they do not tell you whether it is an over provision or the under provision. Simply, it will be mentioned in the trial balance, and you have to select or you have to judge yourself whether it is an over provision or under provision. Now, how will we know whether something presented in the trial balance is an under provision or the over provision? So you have to see the debit and the credit side. If it is on the credit side, that represents over provision. If it is on the debit side of the trial balance, that simply represents under provision. So under provision will increase the current year tax charge, and over provision will decrease the current year tax charge. So this is the treatment that you should remember, and shortly we'll be doing some sample questions as well. So right now we have an example. Rompel's tax department has estimated the tax charge for the year ended 31st December 2008 as 36,780. So this is the current tax provision. because it is written Romble's tax department has estimated the tax charge for the year ended. So when it is written estimated the tax charge, that means it is the current tax provision. There is currently a credit of 1630 on the tax payable account. So you see there is a credit balance. Now credit balance represents the over provision. And I've already told you that over provision will decrease the current year tax charge. What amounts are reported in the Rombal's financial statements for the year ended 31st December in respect of the current tax? So you have the current tax provision, which is simply the expense as well as the liability, and then you have the over provision, which will reduce the current year tax charge. So in the tax liability, we'll present 36,780, and in the statement of profit or loss, the over provision will reduce the current year tax charge, and the net tax expense is going to be 35,150. So remember this thing for the exam, that over provision represents the credit balance and it is going to reduce the current year tax charge. So this 36,780 is the current tax provision. Debit profit or loss 36,780, and credit tax payable, that means simply your current liability 36,780. Alright, now we have another example. Simple has estimated its income tax liability for the year ended 31st December 20x8 at 1,80,000. In the previous year, the income tax liability had been estimated as 1,50,000. Required. Calculate the tax expense that will be shown in the statement of profit or loss for the year ended 31st December 20x8 if the amount that was actually agreed and settled with the tax authorities in respect of 2007 was 1,65,000 the first case and 1,40,000 the second case. So you see in the previous year the tax estimated was 1,50,000. If the actual tax is 1,65,000, then this will represent 15,000 as under provision. And under provision will increase the current year tax charge. That means this 15,000 will be added in 1,80,000. In the second case, if the actual tax is 1,40,000, then this will represent 10,000 as over provision. And remember, over provision will decrease the current year tax charge. That means you have to reduce this amount from 1,80,000. So we can simply write this thing over here. 1,80,000 is the current tax provision. Under provision will increase the current year tax charge. This 10,000 represents over provision. Over provision will decrease the current year tax charge. So this is the answer to your question. So 1,80,000 plus 15,000, 1,95,000 will be in the statement of profit and loss, and here it is going to be 1,70,000 in the statement of profit and loss. So you can see 1,95,000 and 1,70,000 is the answer. The first case was the under provision, the second case is the over provision. Now we are going to talk about the most important thing in the IAS 12, which is deferred tax. Now we are not going into the detail because we are dealing with the crash course. But in the crash course, we are going to be highly exam focused. We are going to talk about all those essential things which are really important for the exam. And that will be coming up in your exam question. So what is simply the deferred tax? Now, when you talk about the deferred tax, first of all, you should know What is the difference, or what is differences? In the differences, we'll be talking about two types of differences. The first one is the temporary difference, and the second one is the permanent difference. Now, difference of what? When you prepare the financial statements, you have prepared the financial statement based on the accruals basis. For example, you have recorded the expenses even if it is not paid. You have recorded the income even if it is not received. So accrual concept says that the income and expense should be recorded in the period to which they relate, not on the cash basis. But the tax department deal with the cash basis. Whenever they see expenses, they make sure that this expense has been paid. When they see the income, they make sure that this income has been received. So when you are dealing with the accrual basis and they are dealing with the cash basis, there is going to be a difference. That is known as the differences. Sometimes, in fact, most of the time, that difference is going to be temporary. For example, you have recorded provision as an expense, debit provision, expense, credit provision, liability. So an expense in the statement of profit and loss and a liability in the statement of financial position. Based on the concept of IAS 37, that if the outflow is probable, you are going to record a provision, you are going to book a provision. So you have recorded provision as an expense in the statement of profit or loss. But the taxation authority is not going to consider that thing till that is paid. Let's assume we have recorded the provision related to warranties, that there may be some claims that will be coming up in the future and we have to spend some money on those claims. But you have not yet spent any amount on that. The taxation authority says we are going to consider this expense when you actually spend some money on the claims. So that means the difference will be temporary. Right now we have not paid or we have not spent any amount on the warranty provision, but there will be an amount in the future, and when we spend that money, the taxation authority is going to consider that. So that is an example of the temporary difference. The temporary difference means the taxation authority is right now not considering anything, but they're going to consider it in the future or vice versa. The permanent difference will not be settled between you and the taxation authority because they are never going to consider that thing. So remember, whenever we are talking about the deferred tax, we will be only dealing with the temporary differences. And these differences are actually the difference between the carrying value, which is the amount in your books, and the tax base. The tax base is the amount in the books of the taxation authority, or you can say the tax base is the amount that will be considered for the taxation purpose. So the deferred tax is simply the estimated future tax consequences of transactions and events recognized in the financial statements of the current and the previous period. Deferred taxation is a basis of allocating tax charges to a particular accounting period. The key to deferred taxation lies in two quite different concepts of the profit. The accounting profit, which is the figure of the profit before tax reported to the shareholders, and taxable profit, which is the figure of profit on which taxation authorities base their tax calculations. As I've told you, the difference between the accounting profits and the taxable profit. Accounting profit, which you have calculated by using your own basis, and the taxable profit is the profit which has been calculated by adjusting those things which are not considered by the taxation authority, or they are providing you their own basis, such as for the depreciation. We know that depreciation is an expense. Now, the depreciation is a non-cash expense. When you are recording the depreciation of any asset, you have not spent any money, you have not given any money to someone. It's simply the allocation of cost over its useful life. So the tax authority does not consider the depreciation as an expense. Instead, they allow you the capital allowance for the tax depreciation. Now, the rates may vary. For example, you're recording the depreciation based on 20% straight line method. They may give you the 50% allowance straight away. Now, this 20% and 50% will make the difference. You are going to calculate the carrying amount based on this 20%, but the tax base will be calculated based on the 50%. But this is again a temporary difference which will be settled in the future. And that temporary difference is giving rise to either deferred tax liability or the deferred tax asset. So here we have the discussion of the temporary differences and permanent differences. The temporary differences, as I've already told you, let's give you an example. For example, we have an asset, the cost of an asset is 100,000 and the life is, for example, 5 years. So what is going to be the depreciation charge per year? 100,000 divided by 5, the depreciation is 20,000. So in the first year, the carrying value of the asset is going to be 100 minus 20 is equal to 80,000. 80,000 is going to be the carrying value in the first year. Now this depreciation is not being considered by the taxation authority. Instead, they allow you the tax depreciation, which is known as the capital allowance. Say, for example, they have allowed you the 50% tax depreciation. Now, according to them, the asset will be depreciated over the 2 years. So, the tax base is going to be 100,000 minus 50,000 is equal to 50,000. Now this is the carrying value and this is the tax base. Look, these two are significantly different. And this will give rise to the temporary difference. One more thing, you are actually recording the expense of 20,000 in your financial statements. The taxation authority is saying to record 50,000 as an expense. Now when you are recording 20,000 as an expense, it will actually decrease the profit, but that decrease will not be more than the 50,000. Let's assume the profit before the depreciation was 200,000. Now 200,000 minus 20,000 is equal to 1,80,000. But if you deduct 200,000 minus 50,000, the remaining profit will be 1,50,000. You were supposed to pay the tax on 1,80,000, but due to the adjustment told by the taxation authority, you will be paying the tax on 1,50,000. That simply means you are paying less tax now due to the adjustment suggested by the taxation authority. So the reason you are paying less tax now, but that will be adjusted in the future, will give rise to the deferred tax liability. You are supposed to pay the tax on 1,80,000, but now you are paying on the 1,50,000 because of the adjustment suggested by the taxation authority. So listen again. You are paying less tax now due to the adjustment suggested by the taxation authority, so that less tax will create a difference and difference will be recorded as a deferred tax liability. Similarly, when you say the provision, say for example warranty provision, debit profit or loss, credit provision. Now you have recorded an expense which has not yet been paid. The taxation authority is not going to consider that expense because that is not yet paid. So you will not record that expense in your financial statements. So when you are not recording that expense, say for example 50,000, when you are not recording that expense of 50,000, you have to pay the tax on more profits. So due to the adjustment suggested by the tax authority, you will be paying more tax now but in the future you will get the adjustment once the warranty provision is actually paid. So you are paying more tax now because of the adjustment suggested by the taxation authority. This will create a difference, and that difference will be recorded as the deferred tax asset. Now, if you're getting confused with my example that how to record the deferred tax liability in the deferred tax asset, there is no need to get confused because in the exam this is going to be quite straightforward. We will be dealing with the examples in a while where you can simply understand that in the F7 it is simply a piece of cake to calculate the deferred tax liability or the deferred tax asset or the charge to the statement of profit and loss. What I was explaining to you is that temporary difference is actually the difference between accounting profits and the taxable profits. Sometimes you are paying less tax due to the adjustment suggested by the taxation authority. Now that difference is actually recorded as the deferred tax liability. Sometimes you are paying more tax due to the adjustment suggested by the taxation authority. That difference is recorded as the deferred tax asset. Now we have an example. We have already studied that carrying amount is the amount in our books and the tax base is the amount which is considered for the tax purpose. So we are having an example related to the assets. A machine cost 100,000. Depreciation of 18,000 has been charged to date. Tax allowance of 30,000 have been claimed. Now, if we deduct 100,000 minus depreciation, the carrying value will be 82,000. If we calculate the tax base, which is 100,000 minus allowance, it is going to be 70,000. So carrying amount is 82,000. That is cost minus depreciation. And here 70,000 is a cost minus capital allowance. So you see the carrying value is more than the tax base. Carrying value is more than the tax base. This will create a temporary difference of 12,000. This is known as the taxable temporary difference. The taxable temporary difference. Now why we are calling it as taxable temporary difference? Because whenever the carrying value is more than the tax base, this is going to create a taxable temporary difference. And when the tax base is more than the carrying value, this will create the deductible temporary difference. So when you multiply the taxable temporary difference with the tax rate, it will give you the deferred tax liability. And when you multiply the deductible temporary difference with the tax rate, it will simply give you the deferred tax asset. All right, another example. Interest receivable in the statement of financial position is 1,000. Interest will be taxed when received. Now, interest receivable, because it belongs to the current year, so what is going to be the double entry? Debit interest receivable, credit profit or loss, because we already record that thing as an income. So in the carrying amount we have 1,000, but the tax base is nil because the taxation authority is not going to consider until it is received. So again you have the temporary difference of 1,000. Trade receivables have a carrying amount of 10,000. The revenue has already been included in the taxable profit. So here the carrying amount and the tax base both are same, so the temporary difference would be nil. Inventory has been written down to 500 to 4,500, so 5,000 to 4,500 in the financial statements. The reduction is ignored for the tax purpose until the inventory is sold. Now, we know that inventory should be recorded at lower of cost or NRV according to IAS 2. But this thing can be misleading. The taxation authority is not going to consider this thing. They're going to say, okay, we are going to take the NRV when the actual inventory is being sold. So in our books, we have the lower of cost or NRV 4,500, but they have the 5,000 in their tax base because they are going to consider the NRV when the inventory is actually sold. Till that, they will be taking the cost as the tax base. So it will create a difference of the 500. Then we have some examples of the liabilities. Current liabilities include accrued expenses. Now we know accrued expenses are the expenses that belongs to the current year but not yet paid. This is deductible for the tax on the cash paid basis. The tax authority is going to consider when the actual expense is paid. So we have an obligation of 1000 but the tax base is nil. This will create the temporary difference. Accrued expenses have a carrying amount of 5,000. The related expense has been deducted for tax purpose. So here the carrying value and the tax base are same. So the difference is going to be nil. So what you should understand right now over here is that the temporary differences are calculated when you compare the carrying amount with the tax base. Now the temporary differences will be of two types, which I've already told you. Temporary differences. It is going to be taxable temporary difference and deductible temporary difference. So taxable temporary difference and deductible. So when the carrying value is more than tax base and when the tax base is more than the carrying value. So the deferred tax asset. Deferred tax asset is simply when the tax base is more than carrying value. This will give rise to deductible temporary difference, and when you multiply it by tax rate, it will give you the deferred tax asset. The double entry is deferred tax asset debit, credit, profit or loss. The deferred tax liability is opposite. So when the carrying value is more than the tax base, this will give rise to taxable temporary difference, and when you multiply it by tax rate, it will give you the deferred tax liability. So deferred tax liability should not be discounted, and debit profit or loss, credit deferred tax liability. Now, do you remember that allowance for receivable thing from your financial accounting knowledge, or provision for doubtful debts? Now we call it as allowance for irrecoverable debt. So we used to create an allowance, and in the next year we were just looking for increase or decrease in that allowance. The deferred tax works the same. Once you have recorded either the deferred tax liability or the deferred tax asset, next time you are going to just see the increase and decrease in that. So if there is an increase in the deferred tax liability, this is going to be recorded as an expense. Debit tax charge, credit deferred tax liability. If there is a decrease in the deferred tax liability, that will be simply a reduction in the liability and credit will go to the tax charge. So debit, deferred tax liability and profit or loss will be credited. The deferred tax asset is opposite. If there is increase, asset will be increased and there will be a credit to the profit or loss. If the deferred tax is decreased, then there's going to be an opposite entry. So remember this thing. Once we have recorded the deferred tax asset or the deferred tax liability, next time you're going to just see the increase and decrease in that. So how to record these assets and liabilities? So we are going to record the current tax provision in the current liability, the deferred tax asset or deferred tax liability in the non-current asset or the non-current liability, and the tax charge will go to the statement of profit or loss. Now there is a specific situation related to the revaluation, which is something common in your F7 exam. We'll be doing a question on that as well. When there is a revaluation, in most cases the upward revaluation, the carrying value is increased, but the tax base remains static, remains nil, because the taxation authority does not consider the revaluation. So the tax base stays nil and the carrying value is increased. So that will make the case that the carrying value becomes more than the tax base, and there will be the taxable temporary difference. And when multiplied by the tax rate, this will give rise to the deferred tax liability. So remember one thing, whenever there is a revaluation, that revaluation will have the deferred tax consequences. Sometimes in the question it is written, ignore deferred tax thing. That means you are not going to take deferred tax on the revaluation. But if it is written that the deferred tax revaluation will have the deferred tax consequences, then remember that the revaluation will have the deferred tax liability thing. Because the gain or loss on the revaluation is recorded in the other comprehensive income, so does the deferred tax. The deferred tax will also be recorded in the other comprehensive income. Now we need to have an example to understand this concept. Alright, an entity Dodge owns property, plant and equipment that cost 100,000 when purchased. Depreciation of 40,000 has been charged up to the reporting date of 31st March 20x1. That means we can simply calculate the carrying value 100,000 minus 40,000, 60,000. The entity has claimed total tax allowances on the asset of 50,000. On 31st March, the asset is revalued to the 90,000. The tax rate is 30%. Now, what is the requirement? Explain the deferred tax implications. Now we know that the revaluation will increase the carrying value, but that revaluation is not considered by the taxation authority. That revaluation is not considered by the taxation authority. So we need to have the deferred tax consequences. The carrying value will become more than the tax base, and that will give rise to the deferred tax liability. So simply see that the carrying value is how much? Carrying value is 100,000 minus 40,000. That means 60,000. This is the carrying value. What is the tax base? 100,000 minus 50,000, because the capital allowances claimed so far is 50,000. So the tax base is 50,000. So the carrying value is 60,000 and the tax base is 50,000. So when the carrying value is more than the tax base, that give rise to the taxable temporary difference. So you see over here, the carrying amount of the asset is 90,000 and the tax base is 50,000. The carrying amount exceeds the tax base by 40,000, 90,000 minus 50,000. This temporary difference will give rise to the deferred tax liability of 12,000. Now how it is being calculated? 60,000 was the carrying value and now the revalued amount is 90,000. So this 30,000 is the revaluation gain. Now the tax base was 50,000 and there's no increase in the tax base because the tax authority does not consider the revaluation, so the tax base remains same. So 90,000 and 50,000, the difference is the 40,000, which is the taxable temporary difference. And when you multiply it by the tax rate, 40,000 to 30%, 12,000 is the deferred tax liability. Right? 12,000 is the deferred tax liability. Now we need to calculate the deferred tax on the revaluation. What was the revaluation gain? The revaluation gain is 30,000 and you multiply it by 30%. So 9,000 is going to be the deferred tax on revaluation gain. As I have told you that the gain is recorded in the other comprehensive income, so does the deferred tax. So what you're going to do is the gain 30,000 and minus 9,000 deferred tax. The deferred tax is realized in the same way as we do the revaluation thing. So 30,000 minus 9,000, which is the deferred tax on the revaluation. Now we are talking about the most important thing, which is the standard working. So how you are going to record the figures in the statement of profit and loss and in the statement of financial position. This is the most important thing that we are going to discuss now. So you are going to take the year-end estimate, which is the current tax provision. Usually this will be given in the exam. Under provision will be the debit balance. Over provision will be the credit balance. So under provision will increase the current year tax charge. Over provision will decrease the current year tax charge. And then increase or decrease in the deferred tax liability. Increase in the deferred tax liability is an expense that will be added to the above expenses. Decrease in the deferred tax liability will be deducted from the above expenses because that is credit to the statement of profit and loss. So remember this thing. The first thing you have is the current tax provision, which is an expense. Then you have under provision, which will increase the expense. Over provision will decrease the expense. So you need to remember this working. Increase in the deferred tax liability is an expense that will be added to the above expenses. Decrease in the tax liability will be deducted from the above expenses because this is credit to the statement of profit and loss. This is the net figure that will go to the statement of profit and loss as a tax charge. Now the other thing that will be given in the exam is the opening balance of the deferred tax, which will be in the trial balance. The closing balance needs to be calculated. So what you will be doing, temporary difference multiply by tax rate. Sometimes they have already given you the closing deferred tax liability. In that case, you just take it straight away. But in most cases, they give you the temporary difference and you multiply it by tax rate to calculate the closing deferred tax liability. Usually, these two things will be compared. Closing deferred tax liability and opening deferred tax liability. But sometimes when you have the revaluation thing in the question, then you need to deduct the revaluation deferred tax from this as well. So revaluation property that means deferred tax on revaluation, and this is the figure that will represent increase or decrease, which will be taken over here. So again, I'm repeating that. Year-end tax estimate expense. Under provision, increase the tax charge. Over provision, decrease the tax charge. Increase in deferred tax liability is expense that will be added to the above expenses. Decrease will be deducted. When you are having the deferred tax, you have to compare opening deferred tax liability with the closing one. Opening is given in the trial balance. Closing needs to be calculated. Sometime it is given as well. If you are having the deferred tax on the revaluation, then that thing will be deducted and the net figure will be taken as increase or decrease. Now we have some objective test questions which will be coming up in the exam, and the same thing will be coming up in the final account question. So make sure you are quite attentive. Question number 1. Tamsin's company accounting records show the following. Income tax payable for the year, which is the current tax provision, 60,000. Then you have over provision. Over provision decrease the tax charge. Opening provision for deferred tax is 2600. Closing is 3200. So you compare opening with the closing. Opening was 2600, closing was 3200. So there is increase in the deferred tax liability of 600. Let's take these figures to the previous format. Income tax is 60,000. All right, this is the expense. Over provision is 4,500, which will reduce the tax charge. Increase in the deferred tax liability is 600, which is an expense. Now, what will be the tax charge to the statement of profit or loss? So you take 60,000 minus 4,500 plus 600. It is 56,100, which is the charge to the statement of profit or loss. So make sure you read the requirement. What is the income tax expense that will be shown in the statement of profit or loss? 56,100. Let me write this thing over here as well. Tax provision, which is an expense of the current year, 60,000. This is your liability as well in the statement of financial position. Over provision will decrease the current year tax charge, and then there is increase in the deferred tax liability of 600. So that will give you the 56,100, which will be recorded in the statement of profit or loss. This closing deferred tax liability will be recorded in the non-current liability. So you need to know the extracts. This is the current liability. This is the tax expense in the statement of profit or loss, and this is the non-current liability. Let's move to the question number 2. The following information has been extracted from the accounting records of Clara. Estimated income tax for the year ended 30th September 20x0 was 75,000. This is an estimate. Income tax paid for the year ended 30th September 20x0 was 80,000. That means there was an under provision. There was an under provision of how much? 5,000. They booked the expense of 75,000 and the actual tax was 80,000. So there is an under provision of 5,000. Estimated income tax for the year ended 30th September 2001 is 83,000. This is the current tax provision. Tax provision for the current year. What figures will be shown in the statement of profit or loss and in the statement of financial position in respect of the income tax? 20x1. So remember, 83,000 is the current year tax charge, and under provision will increase the current year tax charge. So in the statement of profit or loss, there will be 88,000 recorded as the tax expense. And in the statement of financial position, the current liability will be the current tax provision, which is 83,000. Now we have question number 3. Hudson has the following balances included on its trial balance at 30th June 20x4. Right. So you have the taxation, and see there is a credit balance which represents over provision. And then there is deferred taxation, which is the opening balance, and the opening deferred tax is 12,000. The taxation balance relates to an over provision from 30th June 20x3, which we already know. We have seen the credit thing, so we know this is an over provision which will decrease the current year tax charge. At 30th June 20x4, the directors estimate that the provision necessary for taxation on the current year profits is 15,000. So the tax provision for the current year is 15,000. The carrying amount of the Hudson non-current asset exceeds the tax written down value, that means the tax base, of 30,000. Here we do not have the closing deferred tax liability. In fact, we have the temporary differences. How we know that this is temporary difference? Because the non-current asset exceeds, the carrying amount exceeds the tax base. So carrying amount is greater than the tax base. So we have the taxable temporary difference of 30,000. When we multiply it by 30%, we have closing deferred tax liability of 9,000. This is the deferred tax liability closing balance. Now over provision will decrease the current year tax charge. How much is that? 4,000. And then there is a decrease in the deferred tax liability because opening was 12,000 and closing is 9,000. Decrease also represents a credit entry. That is why we are taking this thing as negative. Increase represents an expense. That's why we take that in the positive figure. Decrease represents the credit entry to the profit or loss. So what is the taxation expense in the statement of profit or loss? So simply 15,000 minus 4,000 and minus 3,000. So 15,000, which is the current year tax expense, minus 4,000, which is 11, and then 3. 8,000 is your answer, which is the C option, because we are required what should be the figure in the statement of profit or loss. Now we have the example number 4. Holmes has the following balances included on its trial balance on 30th June. Taxation credit, again this represents an over provision. And the opening deferred tax liability of 16,000. The tax balance relates to the over provision, we already know that. At 30th June 2004, the directors estimate that the provision necessary for the taxation on the current year profit is 12,000. So we can simply write current tax provision, which is the tax provision for the current year, is 12,000. Over provision will decrease the tax charge, that is 7,000. All right. During the balance on the deferred tax needs to be increased to 23,000, which includes the impact of the increase in the property revaluation below. During the year, the Homes revalued its property for the first time, resulting a gain of 10,000. And we know the revaluation is subject to the deferred tax, so 10,000 is the gain amount. Multiply by 30%, that gives you simply 3,000. So this is deferred tax on revaluation. Now we have the format again. Let's go back to the format. What is the closing balance? Closing balance is 23,000. Closing balance of deferred tax, we are taking deferred tax working, 23,000, right? Because it is written the balance on the deferred tax account needs to be increased to 23,000. So 23,000 is the closing balance, and then we take the revaluation, deferred tax on revaluation. So the deferred tax on the revaluation is 3,000, and the opening deferred tax is 16,000. So we have the closing deferred tax of 23,000, I'm using my calculator, minus 3,000, which is the deferred tax on revaluation, minus opening balance, so which is 4,000. So 4,000 is the net increase in deferred tax liability, which is 4,000. So 12,000 plus 4,000, 16,000 minus 7,000. So 9,000 is the tax charge that will be recorded in the statement of profit or loss. So remember one thing, the calculation is quite simple. You just take the current tax provision, which is 12,000, If there's under provision, you add that thing. If there's over provision, you deduct that thing. If there is increase in deferred tax liability, you add that thing to the expense. If there is decrease, you deduct that thing. The net figure will be recorded in the statement of profit or loss. The closing deferred tax is your non-current liability, and this 12,000 is your current liability. So you need to remember the extracts. Even in the previous example, what we did, we took the tax provision, which was the current liability, this one, tax provision. Over provision will decrease the current year tax charge, and then we compare the opening deferred tax with the closing, and there was decrease. So decrease represents the credit thing, so we have deducted it. The net amount of 8,000 goes to the statement of profit and loss. So make sure you are just learning this format, and rest IAS 12 is going to be a piece of cake for you. So hopefully you have understood the complete standard.